Hello everybody, so this video is entitled Free AI Plays. Too cheap, are they? Too cheap. I want to talk about three different stocks: Zeta, Wix, and Zoom. Now, fair warning, I own Zeta, I own Zoom, I don't own Wix. Wix is kind of a stock request, but Wix is sort of interesting. So let's go ahead and talk about Zeta. So Zeta, first of all, Zeta, I like the chart. It's in the red hot field of AI. I've covered it multiple times. I've called Zeta the Palantir of marketing. What's particularly amazing about Zeta is that they track hundreds of millions of people in an AI graph, and they can target these people anywhere they go online, on the apps, on the internet. And they have this proprietary data, which are people that they can target and serve ads to, and that creates a moat. And then you build AI on top of that moat. You use AI to target people and to sell more, to have greater conversion rates, greater marketing. They also launched their own Athena AI agent, which pretty much, I'm exaggerating, but it pretty much replaces the entire marketing department. Marketing is going towards AI. AI is becoming marketing. The marketing department is being replaced by AI ads and AI systems entirely. And of course, Zeta, I'll get to that. They just partnered with Palantir. I think that's a very big deal that they partner with Palantir, because Palantir is a company that I've called in the past as a modern ERP, right? Palantir is AI runs your entire business, right? Well, AI is about to run your entire marketing via Palantir on the back end. And so that's why I think this partnership is quite outstanding. Before I get to that, I want to talk about the stock. What I like about the stock is in the past year, it hasn't really moved. We're at 1950. A year ago, you were at 15 and change. So we're up, depending on where you look, between 20 and 30% from a year ago. We're slightly down from when we reached 25 on June 1st, because all stocks are down, right? The past 3 weeks have been absolutely awful in the market. Just bad for growth. So we're down for no reason, really. It makes absolutely no sense. This stock has been range bound. And in my view, under the hood, this business is performing like crazy. It's performing oh so well. And so this is, as you can see, I covered it 4 times already on this channel. Like I said, it's one of my positions. But when I look at their long-term target for 2028, they have long-term guidance. They consistently beat and raise. And if you look at the revenue track record, if you look at the EBITDA track record, the way the free cash flow, I don't really use free cash flow on this channel, but if you look at the way the income statement metrics are trending, there is no fault. The business is growing very, very, very steadily, and the price of a stock is not growing. So this is one of these stocks that sets up for a big pop at some point, because the business keeps doing well and the market keeps ignoring it, as the market is right now. It ignores everything that makes sense, at least in my view, at least in the world of growth stocks. And this guidance, by the way, is likely going to be updated at the next earnings, whenever that is, because their announcement of a partnership with Palantir is quite impressive. So this is opening a future of agentic AI. And of course, by agentic AI, we mean autonomous, measurable marketing action. So you have your Palantir on the back end, who now partner with Zeta, who could be triggering ad campaigns on its own, running your entire large enterprise on its own. And then you also have a Zeta CEO saying that this partnership in the coming years, so let's say 2028, could lead to $100 million in annual revenue in 2028. Well, given that it's a new partnership, it's not baked into their guidance. And their guidance is 2,300 million in revenue yearly in 2028. So you got to add another 100 million to that. So that's nowhere near reflected in the guidance. And you have a stock who's trading at enterprise value over gross profit, over revenue growth of 0.16, we're at 40 of 57. So when I look at this stock, it pretty much has everything I like, and and it has the data. It has the targeting data, the identifiers that allows them to follow people and target people and serve people ads. And that's very valuable. So I think the stock is too cheap. I think the stock has been unfairly punished over the past 3 weeks, like so many stocks. It's down what, a good 20%, maybe roughly 20% from where it was in June. Makes no sense. So anyways, I like this stock very much right now. I think it's too cheap. Moving to another stock, I do not own this one. So this one is a mini stock request from a subscriber asking me about Wix. I had covered Wix one time on the channel. And Wix is one of these companies. So I don't own Wix, but it's one of these companies that I think is a proxy play. And I see two proxy plays here. I see Zoom. I'll get to Zoom and talk about Anthropic in a second. But so what's the idea behind Wix and Zoom? They're both stable business, perhaps a little boring on their own, right? I mean, website for small businesses and building a website builder for small businesses, that's kind of boring. So sorry, but a little bit, right? And Zoom video conference call. Well, WhatsApp does video conferencing too. I mean, it's kind of boring too, right? Google Meet, they all do it. Cisco WebEx. Oh, hopefully you never used that. But anyways, what's the sweetener in both of these stocks? Okay, so in the case of Wix, we have two sweeteners. One of them is the valuation is dirt cheap. EV over GP over RG is a 0.11. The rule of 40 is 16, but that's because I am being mean with a 2% EBITDA margin. From what I understand, they manage to free cash flow. They don't manage to EBITDA, and as a result of that, their cash flow actually looks much better than their EBITDA margin. So I might have to, if you're seriously considering buying this stock, you might want to look at the free cash flow here and see if you can get through Rule 40. But when I look at the stock price over the past 5 years, we're down 86%. This is a stock that's trading cheaper than even in 2022. I mean, this is a 5-year low for this stock. And like Mr. Market, I mean, this is crazy. This is their 5-year revenue growth. So I'm overlaying it here for you. This is the 5-year revenue growth, you can see, and this is the stock price. So 5-year revenue growth, absolutely stellar. Nothing wrong. The business is steady Eddie. Everything's subscription, by the way. It's a fully subscription business. They have 105 net retention rate. It's just small business owners having a landscaping website or, I don't know, hair salon website or whatever. So it's very, very steady. The revenue has doubled in 5 years. The stock has been divided by almost 20 in 5 years. So it makes it, not quite, but almost. So it makes no sense to me. That stock price action makes absolutely no sense to me. And if you look at the year to date, it's down 75% year to date. That makes also very little sense to me. One of the reasons why I think it's down so much is the market analysts got pretty bearish because they did a reverse Dutch auction. They did a buyback, something higher than that, like something, I guess, in the 80s or something. They did a buyback and the stock is now trading at 40. But then again, look at how bad of a backdrop we had. We had a very, very bad backdrop. I also want to point out that this stock is located in the heart of the region that has made our stocks go down, right? And so it's, if you look at many of the Israeli stocks, they've all dumped. They've all dumped. Why? Because of the conflicts over there. And that has led to these stocks, I think, being impacted perhaps more than U.S. stocks, perhaps, right? And so I see a confluence of factors, a bunch of factors, which can explain why the stock is down so much, down 86%. And I'll get to the cherry on the cake in a second. The CEO also announced a workforce reduction. Now, this is very bullish to me. This is very, very bullish that, if you're a website builder, your engineers can use AI to better build your website builder. So I love seeing 20% of the workforce go. I mean, it's too bad for the workforce. They'll find a new job. If that happens, they'll find a new job. It's bad for the workforce. But as far as an owner goes, this is actually pretty bullish in my view. And yeah, it makes a lot of sense that a lot of these companies don't need nearly as much of a workforce in order to operate the website builder. At least that's my take. So that's bullish. And of course, reducing the workforce here is going to go straight to the bottom line. So that's going to go straight to improving the rule of 40, straight to improving the free cash flow, right? And look at this free cash flow. I mean, by the way, 2005, 600 million worth of free cash flow. A bunch of that was spent on the buyback, but a very highly free cash flow business. But to me, the reason why I think this stock is interesting is the icing or the cherry on the cake, and it is Base 44. You may have seen Base 44 online. It is talked about by quite a few influencers, if you ask me. And it's one of the, I feel bad saying that, but it's one of the lesser vibe code companies, right? It's a lesser vibe coder. It's an up and coming vibe coder. Nonetheless, despite not being Cursor, right? Despite not being Claude Code, nonetheless, I think you may have heard of it. I've definitely heard of it. Point number one. Point number two. In 1 year, it achieved $100 million in ARR. That's going to be added to the nearly $2 billion in revenue in 1 year. This was in March. So what is it now? Is it 120 million? Is it 140 million? What is it now? I don't know. But it's one of the fastest growing software platforms in history. I'm not saying they're the fastest growing vibe code platform. I'm sure Cursor is growing even faster than that. Well, I'm not sure actually, but it would make sense to me. But here's the thing. The market is giving them no credit for owning Base 44 outright when Cursor was just acquired by SpaceX for $60 billion. For $60 billion. So if Base 44 is just worth 1% of Cursor, well, that's not reflected in the stock price. If it's just 1% of Cursor, it's not reflected in the stock price. At least that is my take on this, and I think the market might be undervaluing this stock quite a bit. Now, I'm not in it, so if you want to know if I ever get in it, follow me on Patreon, and that's where I let my followers know if I actually buy a stock or not. Although I did tell you that I own Zeta, and of course I own Zoom. So I'll conclude with Zoom. So Zoom took us on a roller coaster. So I started covering it about 2 months ago. Entered the stock, liked it in the 85. My cost basis is like 85 or something like that on Zoom. Anyways, I liked it very much. We went up 34% at 110, and then we went all the way back down, like full roller coaster. You know what hasn't changed though? The Anthropic valuation. The Anthropic valuation is now about $1 trillion. When I first made this video, Anthropic was worth about 800 billion, and I've made older videos too about Zoom. So $1 trillion, and they own, again, we would have to recalculate because they raised more money, but it seems like they would own about 1% of Anthropic now. So 1% of $1 trillion, in my view, and if you add the bunch of cash that they have on their balance sheet, and if you add the fact that even though Zoom is not a high-growth business whatsoever, it's not a high-growth business, but it's a cash-flowing business, and they're still growing their 5%, 6% a year. Zoom calls, they're not nearly as big as they used to be, but they're not really going away entirely either. Like, to me, without cherry on the cake, this stock wouldn't be interesting. This stock is interesting because it owns 1% of Anthropic. And at this point, I believe that you could make a case for Zoom's entire, we're not going to use market cap, but we're going to say the entire EV, enterprise value, because they have a lot of cash in balance sheet. But their entire enterprise value might very well be explained by these 1% of Anthropic. So I find this stock very cheap. I find it interesting that the market hasn't really re-rated it because the analysts are aware of the 1% stake. If you listen to the call, the analysts ask questions about the big stake in Anthropic. Zoom saying, "Oh yeah, we're integrating it in the Zoom call." Blah blah blah. But yeah. And I'll conclude with this. Anthropic seems to be still the leading AI company. Still to this day. And if you look at what just one top engineer from Google, leaving Google to go to Anthropic, that leads Google stock to be down more than 5% in a day. That was that news. So Anthropic could be worth more by the end of the year. And so to me, that's my exposure to Anthropic, that's Zoom, and I like that margin of safety because like I said, they have a lot of cash, and Zoom is by itself a very boring business. I wouldn't be too interested, but I find it very interesting if you include the 1% stake, and all of a sudden I just look at Zoom as a margin of safety. Zoom the business is the margin of safety to the upside of the 1% of Anthropic. So I like Zoom very much as a proxy play. Wix is on my radar. Wix could be a proxy play for vibe coding. Who knows, maybe vibe coding will be a next phase of hype in the current AI hype cycle we're in. Anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.